Warning. This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all.
Right, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. In case you're new here, on the weekend, I like to revisit my base case hypothesis. I like to check in about once a week, do a deep dive, have a look at the macro data and just ask myself a couple of questions, right? Are things going approximately according to plan? Have any major invalidation levels occurred? And if not, then at least I can feel comfortable in my assessment that I have some rough idea about what to expect going forward. In every one of these deep dives, I like to just briefly outline the base case hypothesis in case anyone is new here. The base case hypothesis for the stock market was that at the lows, everyone was too bearish and that sentiment was way too one-sided and we were probably going to have some big violent blow off top to all-time highs. And then once we had that, it would probably culminate in a global recession and that rate cuts would probably mark, if not the top, they would mark a top within about the first 2 months of those cuts coming in. Fast forward to today, and I believe we are due a cycle low in the not too distant future, but then out of that cycle low, we'll be looking to set the third and final angle in the parabola. I like to use 3 angles instead of a parabolic curve because I believe they are harder to cheat. You can't just grab them and move them around. So once they're set, and we're committed to those. So far, all we need to do is set that third angle, and then I think we will be in the danger zone, and I think that we will possibly going to see rate cuts in the not too distant future. I know that's not a popular opinion, but if you stick around, maybe you'll see where I'm coming from with that assessment. One of the craziest things for me personally about this blow off top is it is occurring within a massive parabola that goes all the way back to pre-2000. So this is a blow off top within a blow off top, and I have been making the case that we are indeed at the end of some of these longer term multi-decade cycles. For Bitcoin, the idea was fairly similar. The idea was that at the lows, we were going to accelerate, put in an all-time high before the halving, and perhaps even have to entertain the idea of a left translated cycle top, meaning the top will form before November of this year. Similarly, we fast forward to today, we have a look, and the thing looks more or less in line with expectations. The only missing component, similarly for the stock market, is that last third and final near vertical blow off top angle. So if we can get that in the not too distant future, again, everything will more or less be playing out as expected. Of course, invalidation will come from any kind of trendline violations here. The same for the S&P 500 and the stock market. If we see some trendline breakdowns from here, then something else is going on. But all the while that we are not breaking down, all the while we continue to look to accelerate to the upside, then I continue to accept this as what is indeed in play at the moment. For me, the interesting thing about this idea for Bitcoin, similarly, I believe Bitcoin is at the end of its longer term multi-year cycles. I have been suggesting that for Bitcoin, it has had one right translated cycle, meaning the top comes after the halfway point denoted by the yellow vertical bars, followed by another right translated cycle, meaning the top, of course, comes after the halfway point denoted by the yellow vertical bar. The same is true of this one right here. And again, we see another 12-month bear market following a right translated top, meaning it tops after the halfway point of the cycle. And thus, I have been expecting to see the final cycle left translate, of course, meaning it tops before the midpoint. And then as such, we would have to spend an extended period of time, the remainder of the cycle, in what I believe will be the first true secular bear market decline for Bitcoin into that next 4-year cycle low. So that's the base case hypothesis. So far, so good. Not yet invalidated. So now the question becomes, why do I think this is what's in play? And the answer is 3 or 4-fold. First of all, I believe that we are swinging from a highly inflationary environment towards a deflationary environment. I believe one of the biggest contributing factors to this is anything you do to the M2 rate of change will show up in the CPI print with around an 18-month lag. Therefore, since we had such an aggressive ramp up during the C19 era, followed by a very, very severe snapback in the rate of change at M2, I have been suggesting that anything you do to this M2 will indeed show up in the CPI. And thus, we did pretty well at tracking the top of inflation down here into the wobble. We even got the wobble right, and that's what I believe the market is currently getting wrong. in their assessment saying things like inflation is sticky and what comes next is another round of inflation and another round of printing, I have been suggesting, contrary to popular belief, that we are actually about to continue towards a disinflationary period because the rest of this snapback in the rate of change of M2 has not yet presented in the CPI print. Of note here, we have CPI coming out this week and we are getting pretty stretched in this assessment, meaning if we don't see a continuation of disinflation in the next 1 to 2 prints, I will have to hold my hands up and say that I think it's getting unreasonable to stand on this thesis in the face of multiple sticky prints. I had no problem initially calling this a counter-trend wobble, and certainly if we see the resumption of CPI coming off in the next print or two, then again, I will still have no problem calling this a counter-trend wobble. But if inflation continues to stick for another print or two, or even starts to creep higher, then I will have to hold my hands up and say something is wrong. I am wrong in my assessment, but I'm pretty sure anything you do here will indeed show up here with a little bit of a lag. So we're actually going to get to find out this week coming, and by the next one of these weekend deep dives, we should have a pretty clear idea of whether or not this is still in play. I've also been using things like the TMC Global Credit Impulse, which tends to lead by about 18 months the CPI prints, and this is telling us to expect deflation in the not too distant future, meaning I still therefore expect to see continuation of disinflation before eventually CPI slips negative for a short period of time, whilst we have asset price deflation. Again, this thesis is being quite severely tested at the moment, and we will need to see CPI come off in the following week for me to feel comfortable continuing with this stance and posture. But as it stands, more than 50% of the CPI components in the basket are currently running below 2% year over year for the first time since 2020. So that is encouraging. Again, it's going to be a big week for the CPI and for this channel. For those of you wondering what the significance of this is, we've had this before. We see the jolts roll over, the housing market come off, and we see the spike in inflation be resolved to a short period of deflation. All of this coincides with a big recession. I've been making the case that the same thing is happening again. Jolts rolling over, housing market down, looking for that final leg down before ultimately slipping into deflation at the end of a recession. And speaking of the jolts data came out this week, and you can see right here, okay? That is a sign of things to come. That is more than expected if you've been following the work, if you've been following the weekend's deep dives, and speaks to this jolts data at the hard right edge starting to fall off a cliff. At the same time, we've also been tracking the US unemployment rate and looking for this spike at the hard right edge to start to put pressure on the Fed to cut interest rates early. Again, similarly to how the CPI is sticky narrative has been accepted as consensus in the market, the higher for longer rhetoric from the Fed pertaining to interest rates has also been accepted. I am still seeing people tell me that we have to be open to seeing another hike put on the table. Meanwhile, the unemployment data is not favouring that, neither is the inflation data, and as you're going to see hopefully in a bit, there are a few other things that are not in this favour as well. So it is important to point out here that we have existing home sales in black. Okay, this tends to fall off a cliff around 12 to 18 months before we see spikes in unemployment that are synonymous with recessionary periods. So the current spike in unemployment that we are seeing is actually right on schedule pertaining to the existing home sales which lead that spike in unemployment. This week, we did indeed see a non-farm payrolls print significantly above what was estimated and the prior readout. And this has led a lot of people to point at my thesis, my ideas, and say, look, no way, okay, more hikes are coming, no way they cut rates, no way inflation's coming down. But the reality is, not many people trust this data. I am in that camp of people. I do not want to suggest that you should or shouldn't. I think you should make your own decision. But if we scroll down in the comments, you can see these payroll numbers will be corrected down in a month. They have a history of doing this of late. They release the data that is seemingly hot, and then quietly a couple of weeks later, they tend to revise these numbers down. If that is the case, we may well be even closer towards triggering a SAM recession rule, which we have also been tracking on this channel. In case anyone doesn't know, the SAM recession rule indicates a recession is coming when the 3-month moving average of the national unemployment rate, U3, rises by 0.50 percentage points or more relative to the minimum of the 3-month averages from the prior 12 months. As I was saying, we have been tracking this, and since last week, we have increased the number of states from 19 to 20 states now having triggered the SAM recession trigger. And if indeed that data is revised down, we are likely going to see this number significantly move north from the 20. continuing the expected trend in unemployment and continuing the walk towards a recession. This week was data heavy as we also had PMI data come out, and the PMI data is now straight up into recession territory. This right here is the lowest reading since May of 2020, and you can see based on historical levels, this is again another sign hinting at a potential recession in the not too distant future. Based on everything I've shown you so far and some more, I am still making the case that these rate cuts are way closer than most people want to even entertain. Like I was saying, I'm still getting people reach out to me and say a hike is more likely than a cut. Just like I keep hearing, inflation is sticky and is no way going to be coming down. You're certainly never getting deflation. But the current macro environment does indeed favour cuts way sooner than most people are ready for. Powell even started to lay the groundwork at the last FOMC meeting, saying that inflation doesn't even need to be at 2% for officials to start cutting rates, so long as it is moving sustainably in the right direction. Again, this CPI print this week is going to be a very, very big one. And when we look at other central banks around the world and what they are doing, we saw the Swiss National Bank move to a surprise rate cut in March. They were quickly followed by the Swedish central bank that also moved to cutting rates, as well as some places like the Czech Republic. And as of the end of this week, we also have Denmark now cutting rates, following in the footsteps of Canada, who has cut rates, and even the ECB, the European Central Bank, has now officially cut rates. It begs the question, doesn't it? Are we going to see divergence, which is something we don't typically see, or is it more likely that the UK is next, followed by the Fed? Again, I say, I know these ideas are not very popular ideas. I know most people think higher for longer is a thing, sticky inflation is a thing, but one by one, the dominoes seem to be falling. And each week, when we come back to these weekend deep dives, it's hard for me to point at anything and say things look invalidated as it currently stands. Yes, the data is difficult to navigate. Yes, I don't really believe a lot of it. But I have been making the case that these cuts were going to show up for a long, long time. And now, suddenly, here they are, okay? The only two that are missing are the UK and the Fed, particularly if we get a colder CPI print, a surprise to the downside. This week coming in inflation data, I think the writing will be on the wall. All of this as well, if coupled with a revised jobs print in a couple of weeks' time. Again, I say that these rate cuts are much closer than most people are ready for. Something else that I've been using as what I term the signal for incoming rate cuts is the 2-year bond yield. I've been pointing out that the 2-year bond yield tends to lead lower, and if we see this occur, it tells us to expect the onset of a Fed cutting cycle in the not too distant future. We saw it in every other case. And for those of you that know your market history, you know that the stock market tends to top and suffer a significant downside period within the first 0 to 2 rate cuts. It was the same here as well, of course, back in the dot-com bubble. Here's another look at the importance of the 2-year bond yield. We see the 2-year bond yield lower, leading the Fed funds rate, particularly if inflation can have this snapback towards deflation, or on bearish divergence, oscillated divergence that is, for the 2-year yield. And we can see that this looks very, very similar to what we saw back in 2007 to 2009. We saw the 2-year yield lower, the onset of a cutting cycle, and all of this against bearish oscillator divergence. We ultimately saw inflation go up first, but then we saw that slip into deflation as people flee risk assets like the stock market and hide in a safe haven, or a perceived short-term safe haven at least, such as the dollar. So again, I suggest to you, at the hard right edge, people that think inflation is sticky, people that think there's no way rate cuts are coming anytime soon and a rate hike is more likely, to that I simply say, tell that to the bond market. And I think now is a good time to come all the way back to these charts right here and say, not only is everything I've just shown you seemingly in play, but remember, this is against the backdrop of a stock market that is quite late in what I believe is a parabolic blow-off top. Not to mention that parabolic blow-off top is framed within a giant parabolic blow-off top. And in the case of Bitcoin, Bitcoin may also quite possibly be quite late in its parabolic blow-off top. Again, these are not popular ideas, okay? To say that Bitcoin is probably going to do this and may well top some time between July and August alongside the stock market, followed by an extended bear market decline, these are not popular ideas. But unfortunately for most people, the market moves to harm the most amount of participants. As ever, I am open to being proven wrong. I am open to seeing these invalidation levels flash. If they do, I am more than happy to hold my hands up and say this setup, this idea has been invalidated. And in fact, I actually would rather be invalidated, as I've also been very consistent in saying. I would much rather have a nice, slow, steady, up-only, Raoul Paul type, liquiditists type idea where they're just going to keep printing and this thing's going to go up forever and there's never going to be a bear market, there's no recession, there's no global deflationary bust. I would much rather that as a trend follower and a trader. But if this thing starts to go near vertical, now would be about the time to do it. We've got a few days to find a cycle low, and then it should be third angle time if that is indeed what happens. Against a backdrop of Bitcoin flying to the upside, against a backdrop of the 2-year yields coming off. For me personally, there is no other way for me to interpret this data set, and thus I can only come to the conclusion that not only are we at the end of these multi-year cycles, not only are we looking down the barrel at a global recession and deflationary bust, but we are also going to see them have to be forced to cut rates in the not too distant future as a result of things like inflation coming off and spikes in unemployment. So what a wild time to be alive. With all of that said, let's get into some charts. I think, in fact, let's start with the yields. Let's start with the yields because we're just talking about the importance of the yields. And if we, just for the sake of argument, imagine that this green candle that occurred on Friday doesn't exist, okay? At this point in time, one thing I noticed is a lot of people were saying things like, yeah, tell that to the bond market, Camel. It looks like you're right about this, blah, blah, blah. And then we get one big green candle. And it's funny because I see people completely flip. They completely do a 180. They start messaging me on Twitter and they say things like, that's it, another hike is guaranteed. And I think to myself, how on earth do you draw that conclusion? Okay, so here's how I see it. Okay, we had a move down, we have now had a big push up. And so far, that indeed is a big green candle, but it's nothing more, okay? Now, if you're going to champion the idea that tell that to the bond market is no longer going to play out, meaning what we're going to see is yields continue higher and thus the Fed's higher for longer pertaining to interest rates rhetoric is actually going to be true, then you would need to see something like this where we get a breakout of the 10-year yield and yields move higher. If that happens, then we can say, indeed, the bond market has spoken and the bond market no longer thinks rate cuts are coming. But as it stands, just viewing this, which is currently both a lower low, okay, and a lower high, at least for now, we can't necessarily, at least I can't, look at this and say, well, that's it, we're invalidated and yields are going to go straight up to here and there's no chance of any kind of cuts anytime soon. Like I said, this one green candle certainly does not invalidate everything I've just presented to you. And so as ever, things can change and they can change quickly, but this does not yet count as change. Breakout and things get quite different quite quickly. Same is true of the US 2-year yield, right? So far, objectively speaking, if we move some squiggles out of the way so we can see what's going on, okay, we've got a triple bottom in play. That's true. But no sign of any kind of breakout or repair just yet. Now, get above that level. Do something like this, breakout, retest, resumption, and resume to the upside. Then we can start to say, okay, the bond yields are no longer calling for that rate cut. If we go back here, it will look something like this. We've had a move down, followed by a move up and a breakout. Okay, then it becomes very difficult to look at this chart and say, I know what comes next, this. But if what we get is some kind of move into resistance followed by a rollover, and here's the key thing, a loss of support, okay, something akin to this perhaps, then again, we will be able to come back here, look at this and see, okay, this thing is rolling over, tells us to keep an open mind about seeing those cuts. So my point is simply that we have to be open to all outcomes. We have to know our invalidation levels, such as the breakout levels. Where do we break out bullishly? Where do we break down bearishly? And of course, we know the implications of both of those directional changes. But for now, we are stuck in this sideways range. It's far too early, in my humble opinion, to go calling for rate cuts or rate hikes. Okay, we need to let the bond market speak. And then once the bond market has spoken, we should have some level of idea about what is going on. It's a very similar deal for the DXY. Okay, notice we're right in that window to see a half cycle low. That seems to be what we're getting, half cycle low bounce. And notice where we stopped. Okay, if we draw our eyes to the blue, support, breakdown, retest, possible resumption lower into that daily cycle. So again, this one candle is by no means enough information to draw any conclusions from. If we continue higher, recover this support, something like this, okay, then we can say, fine, dollar is strong relative to the other currencies in the basket, probably still got this whole dollar milkshake idea going on. And if this is to happen by the time we get here, you know, the idea that this 3-year cycle low is coming soon seems kind of silly to me. To me, if this is to play out, then we can say with a very high degree of confidence that is the 3-year cycle low, and therefore we are continuing to look for this whole dollar milkshake idea, for this deflationary bust via a bid dollar and a perceived short-term flight to safety as people sell risk assets and move into the dollar. But of course, conversely, if we're going to reject, this would be the area to do it, wouldn't it? Breakdown, retest, resumption off of the blue into a daily cycle low that then proceeds to fail, and then we can talk about finding a slightly later in life 3-year cycle low, scratching this one off. But again, there is no point coming to a full drawn conclusion from one single green candle, which objectively speaking is nothing more than a move back into resistance that was prior support. So again, way too early, but we know our invalidation levels, and that is what is important. Let the market speak, and we will listen. Needless to say, yields up and dollar up means gold down. So I've officially closed this position out, booked the profit on this. I was talking to the members about this. We took the profit on a couple of mining positions and mining stocks that we had as well. So profit locked in across the board for gold. Now waiting to see what happens. If I flip this onto a weekly chart, what you'll notice is it's entirely possible that that right there is the top for the weekly cycle, and thus what we're expecting to see now is something like this into a weekly cycle low due around the mid to the end of July, and somewhere in there, whether it's as low as that, I don't know. It doesn't necessarily have to be. It could bottom at this level, but wherever it forms, okay, once we're in that timing window, that will be the opportunity to go back to full exposure, to take advantage of the next weekly cycle, just like we did back here and here. So for now, profit booked in on all of the gold and the level 3 members positions. Like I said, looking to get back to full allocation, looking to get into some longs back down here. But for now, it's a little bit of a patience game, and we'll see what happens. Some level of chop is probably expected, something like this, right? And then we can go. And as always, we'll probably be looking for some kind of trend line break out of that cycle low as well. For the stock market, I was saying we are right in that timing window now to be looking for some kind of cycle low pullback, some kind of cycle low shakeout. It's funny that I was talking about as we get into the next few sessions and we will likely see some kind of decline into a cycle low. I was saying we should expect to see a bunch of people on Twitter calling for the end, calling for the top, calling for a big bear market. And that is just what we see every single time we find a cycle low. That is what they serve to do. They serve to flush the sentiment, to reset everything, ready for the next leg higher. And the key thing for me is not only have we got to try and find a cycle low here, not only am I looking to increase exposure, add positions, notify the level 3 members, of course, in real time, but if this blow off top really is a blow off top, okay, then we should probably be looking for a third angle to come in out of this current daily cycle. So if we don't do that, if we do something like this and hold this second angle, then the people that are saying this bull market has a lot more legs left in it, the people that are saying that, you know, the markets are going to continue to rally at least until the end of the year, perhaps even into next year, they suddenly get a lot more credit to their argument. But if indeed we find a cycle low and come swinging out of here, okay, then the thing will look exactly as a blow off top is supposed to look. So far, if I grab this fractal from back here and I slap it over the top, you can see that realistically, not doing anything out of the ordinary so far. Again, if we continue to hold this second angle, then this is just normal and to be expected price action, not speaking to a blow off top at all. As I said, set that third angle and it will be a sign of the end, in my humble opinion. Similarly, that seems like a pretty good place for the Nasdaq to put in a short-term top, pull back into a daily cycle, and then Camel will be getting to full exposure by adding a Nasdaq position. Been a while since we've had the Nasdaq. We took this trade from in here, hopped out somewhere in here, I think maybe slightly lower down. And so now we're just waiting to get back in on some kind of cycle low and capture the rest of this move. As always, though, as I was talking to the members about, I don't want to go all in on a cycle low because in here there was a high degree of uncertainty. So I added a couple of positions. I didn't go to full exposure because there was a good chance of seeing a rollover and an undercut. So in the interest of building the exposure slowly over time, not taking too much risk, I have been patiently waiting for this current cycle low to prove itself. And I think, like I said, out of there, we should be looking for that third angle. Again, if we don't get a third angle and we continue to do something more like this, then again, it speaks to not actually having a blow off top in play, at least not yet. And the Dow Jones still kind of hanging around. Now, the way we've set in this current structure up tells me that we are probably going to see some kind of decline, something like this, and then a cycle low and go over the next few sessions. If that's the case, we might have to do some adjusting. We might have to do something like this to capture wherever that low is and use that as the second angle. Once that has been found, that will be the final time I'm willing to adjust this trend line. That will be me committed to that trend line fully. And similarly, we will still be looking for a third and final blow off top angle to come in. Similarly, if it doesn't, then that will tell us higher for longer in terms of stock market and bull market is in play. And of course, if we fail these daily cycles shortly after finding them, that will be, wholly speaking, invalidation on this entire idea. So as ever, we know the invalidation levels, we know where we're right, we know where we're wrong. Russell 2K moving into support. I think this is probably the time, right? If it's going to break out sometime in the next few days, it's got to find a low, have some kind of shakeout, perhaps one final retest of this blue box area, and then we'll be looking for this thing to break out and move higher. If it doesn't, again, it speaks to this idea being slowly but surely invalidated. So again, we know our levels, we know our invalidation. Do something like this, happy days. Do something like this, okay, and it's no longer looking anything like a blow off top should look. I noticed the altcoins got a big sort of liquidation cascade yesterday, but you can see XRP still doing nothing. That's what it likes to do, absolutely nothing. And Bitcoin, I see a whole heap of people coming out and calling for the end of the world. I see some $44,000 and some 40 and 30k calls on Twitter this morning, which seemed a bit weird. But wholly speaking, if I move this fractal out the way, okay, we are still holding above the green area for now. And that green area is this prior high from back here. We are still largely speaking to this consolidation, still largely looking for a third and final angle to come in. Whether it comes in sooner or later is to be determined. The more time we kind of spend chopping around and not doing much, the more I'm leaning on a balance of probabilities that we might have to actually roll over into that next daily cycle low. And of course, if this is to occur with the stock market blowing off, I don't think that's a very good sign. I don't think that's very healthy. So I think everyone should be championing for a big push here from Bitcoin, unless of course you're short and bearish and targeting way, way, way lower down. But if the end really is nigh, if the stock market really is going to put in its final angle, okay, then if Bitcoin's going to do something like this, I don't really see a world in which it recovers thereafter. It's probably going to suffer even further if indeed we do get the trendline breakdowns in the stock market, risk sells off, we get some kind of demand destroying event, and there's probably going to be no alt season in this area either. So be careful what you wish for. For now though, you know, like I said, not really any great deal of change. I see some people, like I said, calling for the end of the world, but really I can barely even notice this move. Okay, we crashed to a level not seen since Monday the 3rd. Okay, so it is what it is. One day at a time as always, and we'll see what the market can give. I am still short VNQ, the housing market, so we'll see. And a bunch of those crypto related equities we got in the members section looking pretty good, to be honest. So despite the bit of red we've got, I think I'm happy with what I'm seeing, and that's encouraging. So as always, as we're approaching these cycle lows for the stock market, expect a little bit of volatility, expect some pullbacks, but just be mindful of exactly where we are in the daily cycle. And where we are in the daily cycle is not too far away from expecting some kind of bounce and some kind of resumption of the primary trend. So as I said, expect top callers over the next few sessions, expect the bears to come out, expect the I told you so gang, and then expect a nice daily cycle low and a push. All the while that low is in and we don't violate it, then it is malpractice to be bearish. I hope you consider what I've said today. I know a bunch of you really like these long format podcast things that me and Cobra Stacker and CPM do. So head over to the What podcast tomorrow. You can catch us there. I will post a link in the community tab tomorrow once this podcast has been uploaded, so look out for that as well. Other than that, I hope you consider what I said today. I hope you can view it with as much objectivity as possible. As ever, all we can do is keep taking it one day at a time, keep being hyper aware of the invalidation levels, and all the while we're not invalidated, then I continue to stand with this posture. I'm your boy Camel. I hope you're doing well in life. Until next time, take care from me. All the best. Cheers. Bye.
Double hump daddy, set the pace.